Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. Well, the S&P 500 closed out a strong first quarter at a record high. Will there be follow-through in these first few days of Q2? We're going to try and find out from our panelists today. Stock strategist Todd Bunton, ETF Research Director Nina Mishra, and market technician Kevin Matris. And Matris, you say that the action that the market displays in these first few days of the new quarter is really important.
Well, I don't know. Yeah, I don't know about the first few days. I mean, yesterday we didn't get the follow-through. You know, we just kind of a lackluster day.
Yesterday being April Fool's Day.
Right. Yeah.
That could just have been a little practical joke from the market.
Playing a little joke on us. But today, I mean, the market is showing some follow-through. But I want to see some real meaningful follow-through. I want to be able to see the S&P get through their intraday highs that we had seen back in 2007. Yep. And what's interesting is, I mean, the NASDAQ has already taken out its 2007 highs, pre-crisis highs. The Dow has, been trading above there for quite some time. For whatever reason, the S&P has just been struggling. So I do want to see it get through there. Prefer to see it get through there with impunity. And then once we do so, we're going to need to see some follow-through. If we don't get this follow-through, the highs that we saw on Friday or what we're seeing right now, those could be the temporary highs for a while until there's a new catalyst to take us to higher levels.
Before we see follow-through, does the S&P 500 need to retest its lows?
No, I don't think so at all.
Okay. No. Nina, you seem to feel that as far as the coming days go, market action is going to depend on really how the market handles the economic data that comes out this week, and there's a fair amount of it.
And we have a lot of economic data this week, and most important, jobs report on Friday. And like we saw yesterday, the market was there was a mild pullback because of the ISM report. But looking at the other reasons for the recent rally, whether it is the Fed stimulus or lack of any other real alternative for the investors or better than expected economic data or earnings reports, those reasons are still valid. So market may continue to go up, though during the last 3 years, April and the second quarter has been rather weak after a very strong first quarter.
So Todd says follow through or not, he expects a likely flatter market for the rest of the year.
I do, yeah. The S&P was up 10% in Q1. And that's, like Nina pointed out, we saw strong first quarters in 2010, 11, 12. Not saying, fourth time's a charm where we see, the second quarter slowdown. Mm-hmm. It's not like if you flip a coin 3 times and you get heads, then the fourth time is more likely to be heads. But there might be something to that in that we've seen economic slowdowns. So like Nina said, I would agree with her, the data this week is very important. Look at that jobs data in particular. If we see 200,000 plus jobs, I think it could send stocks a little bit higher. But don't forget, later this month, we also get first quarter earnings season. I think that will really be a good turning point for the market to see, are we going to hit these kind of rosy projections that analysts expect in earnings in 2013, or are those estimates going to come down and bring stock prices with it?
So with the market being on its first quarter tear, does that mean that it's officially signaling it has put the financial crisis behind it, Nina?
Yes, sort of. I mean, I think Fed gets a lot of credit for that. And compared to many other central banks, Fed has been very, very proactive in dealing with the crisis and avoiding a banking sector meltdown. So in many other countries, we see that the stock markets are still below the levels seen prior to the onset of the crisis. But we are not out of the woods, I would say, but we have definitely come a long way.
And Kevin, you acknowledge that too. Technically, yes, you say, but there are still issues out there.
Oh, yeah. I mean, technically, the market has, as of Friday, all the major indexes have put the crisis behind us. But unemployment is still, not fully recovered. The banking industry hasn't fully recovered. The housing industry, while it's doing fantastic right now, is nowhere near fully recovered. And to some degree, investor psyche has not fully recovered either. So, the market is doing significantly better, and that's a big plus for every investor out there. But, there's still a lot of structural problems that the U.S. is trying to overcome. So in many ways, that crisis is still here, and we're still living with it.
All right. Having said that, and I'm not going to ask you because you're looking for a flat market for the rest of the year, can the market continue its tear here in Q2?
Sure, it can. Let me take this one. What's interesting is that everybody, I remember at the end of last year and beginning of this year, everybody was talking about the magic second half, right? And everything was going to magically turn fantastic in the second half of the year. Well, I mean, one school of thought is that everybody front-loaded the magic second half. Everybody got ready for this wonderful stuff, and here it is. They put it all into the first quarter. However, if in fact we can continue to see the economy get better like most people are thinking, that would mean earnings should go higher. And with valuations still so low, if earnings go up, the valuations are only going to get more attractive unless there is a commensurate price increase. So as long as the economy doesn't derail and you do see earnings estimates ratchet up, I still think that there's more to go in the economy, so higher than flat.
So you say investors should just enjoy the ride.
Well, for right now, you got to enjoy it until the
Okay.
ride stops.
But Todd says they've missed out on a big opportunity here.
Well, yeah, people just now getting into the market after, the 4-year rally. I think they're a little late to the party. That's not to say that we're in for another big crash or a pullback, but people expecting double-digit gains in stock prices, double-digit gains in earnings for the market over the next couple of years. That's not going to
Not
happen.
happening.
I would just say temper your expectations and don't focus only on price appreciation. Let's not forget dividends make up a
Right.
big chunk of total returns over the long haul. Look for some safety and some income here.
Yeah, the one thing I would just say is that, yeah, a lot of the easy money is gone, but there's going to be plenty of double-digit opportunities, but it is now more of a stock picker's market
Yeah.
than anything. So,
And,
yeah.
and Nina, you say when investing from this point forward, keep an eye to the longer term.
Yeah, exactly. Don't play the shorter term momentum investing now, but looking at the longer term perspective, there are still quality names, good U.S. companies with solid balance sheet, lot of cash. They have been growing their dividends and rewarding their investors with share buybacks. So look at those names. Look at some of the faster growing emerging economies, and don't invest in bonds now. Stocks still look very attractive compared to bonds as of now.
And Japan.
Hopefully we've added some perspective to this look at the market and the tear that it's been on. We're going to give you some perspective on some interesting top picks for this week that these folks have brought with them. That is in the next segment that you can click right over to.